Well, oil prices have soared 121% in the last year. What's driving that rally? Stephen Schork, president of the Schork Group and editor of the Schork Report, says it's not fundamentals. Joins us now with his perspective on the energy market. So these are interesting times, Stephen, right? Oil's recent moves have nothing to do really with oil. Why is that?
Well, let's just take a stroll, Lori, down common sense lane, okay? The other day, Total, the French, and it's even tougher for Wall Street traders. The French oil giant Total just announced that it was closing permanently its refinery in Dunkirk in France. Now, that refinery had been shuttered since the fourth quarter. That now brings the total to 600,000 barrels a day of European and North American refinery demand that has been closed permanently. That's on top of the 1.1 million barrels a day in the fourth quarter that was closed indefinitely. So, Lori, in the fourth quarter of 2009, we had 1.7 million barrels a day of refinery capacity that was closed. Lori, there's only one guy in the world who buys crude oil, and that's the refinery, and the refineries were closing shop. Why? Well, we know why now, because we saw it with the earnings with big oil. The two largest oil companies in the largest oil consuming, publicly traded, in the largest oil consuming country in the world, Exxon and Chevron, lost nearly $7 million a day in the fourth quarter because they could not take $70 oil and make any money with it in refinery because they cannot pass along the cost on to, let's be honest, vocationally challenged consumers. This is still a weak economy. We cannot handle oil at $70. The fundamentals, i.e., the bottom line for ExxonMobil et al., do not justify oil where we are today. So obviously, oil's not trading on the fundamentals, Lori. It's trading along the bell curve.
So what's the story here for the refineries? Will it stay status quo?
No, they're going to continue to lose more money because if some Wall Street banks are to be believed, and I really don't think you should believe them, but there is a chance at some point this year you could hit $95 a barrel in oil. Why? Again, if Exxon couldn't make money at $70 a barrel, how, Lori, are they going to make it at $95 a barrel?
Is there a supply issue? A quick fundamental here. Do we have enough supply here with the winter?
We're flush. We had in the heating oil market last week. We saw a 1 million barrel build in inventory, and that's with 40% of refinery capacity in the East Coast shut in. So yes, there is supply. There is supply out there, and there is real demand. Very cold winter out there, but supply's going really nowhere.
And work in the dollar, this inverse relationship that we saw of last year. Where does that stand?
Well, and that's just it. This is a market that trades on where the direction of the dollar is going, not in the direction of underlying cost drivers as supply and demand. So therefore, this is a market that's trading along, as I said, the bell curve. So there is, if you run the probability models based on the volatility, the kind of stuff that poker players use to calculate their implied odds in a certain hand, this is how oil is trading, not on fundamentals. So there is a one standard deviation chance that we could hit $95 a barrel. That's on the upper end of the bell curve. On the bottom end of the curve is, $65, $10 from where we are today. So there's more upside potential. So if you're a poker player, you know what? You buy here, you risk the $10 for the potential that you win $20 or $30. So this is nothing but a poker hand. This has nothing to do with the fundamentals. And again, we know this because if $70 oil really did make chance, then Exxon would have made money in the fourth quarter.
All right, so you've got to stay short term with your oil bets.
Oh, you have to be very quick. I'm in and out. I trade the market. I am in and out of it. At this point, Lori, I think one of two things have to happen between now and the 4th of July, the beginning of the driving season here. Either we need to see a massive correction lower in crude oil prices, i.e. back towards $50, or we need to see a significant correction higher in product prices relative to $70 oil. So what I'm looking at is an increase in the margins for refiners. It has to happen.
10 seconds left. Steve, got to leave it there. Stephen Schork, president of the Schork Group. Many thanks to you.